Chris, today on the program, we are going to be talking about 8 critical moments where we should consider making some proactive moves with our money. And welcome into the program. This is your game plan for retirement. Northwestern Ohio, your resource for a common sense approach to planning with your money for your financial, investment, and retirement future. And your resource for that guidance is Chris McIntire, president and founder of McIntire Retirement Services. Chris, today on the program, we are going to be talking about 8 critical moments in time or in our financial progress where we should consider making some proactive moves with our money. It's not set it and forget it all the time. We've got to pay some attention, and there are times where we do need to take some proactive steps to get the best from our financial future and in our planning.
Yeah, that's a good point there, buddy. And we're not day traders by any stretch of the imagination. Long-term wealth management is what our philosophy is. And just because we see a bad headline here doesn't mean you duck into cash and bury your head in the sand until it seems like the sun is going to shine again. And it's been a challenging couple of years, no question about it. The rising interest rates has hurt the bond prices. Looks like we're tracking for 3 negative years in the bond market, and that doesn't happen very often. And then stock prices, obviously this year pretty much just led by about 7 companies, the big tech heavy ones. So it's really been, and I guess our point here, Peter, is, one of the moves you make in managing money is making sure you do your rebalancing. And, do you need to make sure your stock bond ratio or however your, whatever asset classes that you're using are in line with your overall risk tolerance. And as the market goes up, you need to rebalance. When the market goes down, you need to rebalance. And, typically we're doing a rebalance on a quarterly basis as needed to stay in line with, those risk tolerances of, hundreds of our clients.
And I know, Chris, that you stay on top of those things and also want your clients to understand what's going on with their money. Market's complicated here. I mean, with all of the volatility that we've seen, these different forces and factors that we've really never dealt with before in some instances, and then we have, but they've been difficult in others. I know that you try to keep a check on those things on behalf of your clients, but also proactively communicate with your clients so that they also in turn understand some of these forces and factors that are impacting the markets and then therefore their growth and financial progress.
Yeah, no question about it, buddy. And, we really, I'm a big fan of dividend type paying stocks for the equity position. In 2022 has not rewarded those types of investors. But the nice thing is you've still been getting paid the dividends. And, if you're screening the companies and using companies that have a history of increasing their dividend payouts, that means you're getting more work for your money by doing absolutely nothing. The share price of that stock is going to go up and down, but we're really looking at that for that increasing dividend. I mean, how wonderful is it to put $1,000 in a company like IBM and know that you're going to get more and more money out of that every year because of their track record of doing that for a long time. And so again, that's where, dividends also get reinvested and buy more shares when the prices are down. And, we have to continually educate our clients that say, look, my portfolio is down this month. It's like, well, it's weighted heavily in dividend paying stocks. And if you look at how many dividends were paid out over the course of the quarter or the year, if you're not taking those as income, that money's getting reinvested and we're buying more shares at lower prices. So, I've always been an advocate for dividend paying stocks and more so now than ever, and probably looks more favorable asset class into 2024 as they will eventually stop this interest rate increasing and actually probably cut interest rates at some point in 2024 to, make sure we don't, fall into a deep recession. And, That's just an opinion, not a professional analysis here on a radio show.
But that does seem to be their tool, right? There's monetary policy, there's fiscal policy, the two sort of battle of which one's in control, and if the market's going well and inflation is in control, low interest rates just fine. But when inflation seems to peak, we've got to raise the interest rates to slow production and demand and keep inflation under control. But if there is a downturn in the market as well, we want to stimulate the economy. So vice versa, they're balancing it and lowering interest rates, and who knows what the future holds. But that seems to be where the two intersect in that balance. And ladies and gentlemen, maybe you don't want to keep a pulse on this day to day, minute by minute. Maybe you do, but also would like the help and the assistance in formulating the plan, because the investment approach is not the totality of planning. You've got to think about your taxes, your social security, maximization, your income, healthcare, legacy, all of these things that come into play and must be coordinated for a comprehensive, cohesive, and confident plan. That's what Chris McIntire does with and for his clients each and every day there at McIntire Retirement Services. You're welcome to pick up the phone, give a call, be in touch, and set up a time for ask Chris anything, just a couple quick questions over the phone, or a complimentary review and strategy session, a time to dive into the details of your plan and your investments, understand the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, as well as get that written plan put together. If you'd like to do so, pick up the phone now, give a call. 800-868-1194, 800-868-1194, 800-868-1194, or skip the phone altogether. Always available online at McIntireRetirementServices.com, McIntireRetirementServices.com. Chris, with the headlines, it seems like they're talking about, well, the market's up this year. You mentioned that it's really just a concentration of about 7 jumbo companies, very, very large companies, mostly the tech companies, that have led the way. Conversely, those same companies were the ones that lost the most last year, right? And so in the balance of everything, they're sort of back up to where they were. And just like the value and dividend stocks that you were talking about, they didn't lose as much last year, but haven't gained as much this year. So I guess all that to say, does the news headlines and the small concentration of jumbo companies that can weigh and swing the market so dramatically make it difficult to understand what our expectations with the market should be?
Well, I would say not where I'm sitting, as the investment advisor and all the different type of information that we get, and we had just attended our annual conference there at Brookstone Capital Management just a few weeks ago. In going through the explanation of all of this, that the average client certainly isn't going to get that. They want to know that their account is going up, not going down. And they, a lot of them don't understand the dividend reinvestment. They're simply looking at statement values, month by month. And that's certainly a challenge, because we're educators as much as we are advisors, and then sometimes we're psychologists as well to help them deal with the emotions of what goes on when the market's going down. Like, I had a client's daughter that we're giving some advice to, and she's in some high dividend paying stocks, and it's paid out so much in dividends, it's actually been equal to 3, and by the end of the year, it'll be equal to 4 months of contributions she's been making into her account. So, I mean, that's the value of dividend paying stocks as an example. And, so again, we are a coach, we are an advisor, we're a psychologist a lot of times. So we do wear a lot of different hats to try to educate the average investor that, doesn't really understand how this, over an economic cycle, how does this work? Because it's hard to say, all right, we're selling dividend stocks going into growth stocks. We're selling growth stocks going into value stocks. I mean, and to time all of that, if you have a high degree of risk tolerance, you're going to own a little bit of all of those as well, right? That's diversification.
Yep. And these are all the things that we need to understand in the planning, ladies and gentlemen. And then also understand that there are moments that we may need to change or pivot or just do some routine maintenance on our account. So that's what we're talking about today. These are opportunities or issues that we may be facing that would require some of that proactive maintenance to the accounts. The 8 moments to move your money, ladies and gentlemen, is what we will be talking with Chris McIntire about on today's program. And if you would like this list, the 8 moments, the 8 times that you should consider a little explanation of when and why and how you can identify each of these different items, pick up the phone, give McIntire Retirement Services a call. It is a report that they can provide to you, the 8 moments to move your money. And you can get that to go over on your own time by calling 800-868-1194, 800-868-1194. Now, Chris, important to note that this first one, and there are a couple others within this list, it does not require a total relocation of funds. In fact, several of these items are just changing things within the current accounts that we have, such as with your 401k. We may not be talking about like moving that or rolling it over, or if there's a brokerage or investment or IRA account. Some of these don't require you to completely relocate, but they are movement of dollars within the accounts that investors need to be cognizant of the importance of. And so that's some of the routine maintenance along the way that can help to provide more leverage for forward progress. The number one on the list being a big one that is unfortunately maybe too often overlooked, rebalancing on a regular basis. As you've mentioned already in the program, that rebalancing is vitally important to long-term financial success.
Yeah, it keeps you from overweighting in one particular asset class. Like, if you were in the growth sector and it goes up 30% this year, you're certainly going to have a lot more in stocks than you would in your fixed income side, if you will. And as interest rates are up and coming, heck, even money markets are attractive right now over bond performance. So, it's important to do that rebalance. We've working our way out of, real estate, for example, and just putting that money in a money market fund that's generating around a 5% annualized rate of return, and that's essentially what we were getting out of the fund that we're moving it from. So, that's again part of a rebalance. And like you said, look, sometimes you do got to adjust the strategy pretty, on a wider scale. And that'd be a good example of it right now. We're doing a lot of that with clients on a daily basis right now going into the fourth quarter here.
And we already talked, Chris, about the difference in the movements of the tech stocks versus the value and the dividend. That would maybe be another example. If we've got our equity portion, and let's say we started 2022 with 50-50 tech for part of it, and then value or dividends for another part. The tech went way down, the dividends didn't as much. Rebalancing would have allowed us to take advantage of those lower prices and maybe benefit a little bit more this year as the tech has roared back, right?
Yeah, that is correct. Yep. Especially if you don't need the income, for example, because it's hard to build your entire portfolio off of just growth. Because what if you don't get growth? That's where the dividends are very helpful. If the prices aren't going up, at least you have that dividend income coming in and you're still living off of the work that's being created by the stock itself. On a growth stock, you're living off of just the price of that stock going up. That would not have been where you wanted to be in 2022, for example.
And however, over the last 10 to really maybe 14, 15 years, Chris, the market has been on a fantastic run. Yes, of course, we've seen a couple hiccups along the way, COVID 2022, just two examples. But overall, I mean, we have seen phenomenal growth in the market. If 10 to 15 years ago, we had decided that our risk tolerance allowed for an appropriate 50-50 portfolio mix, and then we let it ride without rebalancing, we probably have far more risk today than we started with and thought was appropriate 10 to 15 years ago. And we're 10 to 15 years closer to our retirement. So 2022 comes along and people may have lost more than they were comfortable with if they had not done this routine movement of money, this rebalancing that is one of these financial fundamentals for success.
Yeah, and that was a painful year for sure, especially for those who had just retired, no question about it. and it takes some time to recover, because once you start pulling money out of the portfolio, you're asking it to do two things: provide income, and then also, to grow what may have been taken away from the value in 2022. And now we're looking at, higher inflation rates. So there's a lot of forces right now, right? High inflation rates, high interest rates. Is the economy going to slow down here? And then, does that slow down the growth sector, where dividends are going to become more important, in interest from bonds and whatnot, which, we would look at to into, especially the second half of 2024, that, hey, we might get some solid potential performance out of boring asset classes. And that's nice,
Yep.
for the folks that are looking for income for their retirees.
Well, we definitely saw an improvement in interest rates. You want to talk about better performance from something that has been very boring for quite some time. Even CDs back up to a place, maybe not keeping up with inflation or giving us all of the growth that we need, but certainly better than they were just 24 to 36 months ago. And Chris, I know that you can help clients secure some of these better rates in even those more conservative kind of vehicles like CDs right inside of their investment accounts. So, ladies and gentlemen, if you don't have a high risk tolerance, you are maybe risk adverse on the moderate to conservative end of the risk spectrum, there are opportunities that you can take advantage of. And certainly, if you've got excess cash and checking and savings that you have not seen improvement on, it is something to explore. Rebalancing, one of the reasons why people are making better progress with their money and investments. If you do that, then you've got the opportunity to capture gains when they're available and purchase opportunities when prices are on sale. If you don't, you may miss those chances. And that's why it's the number one moment to move your money on the list. By the way, does not necessarily require you to relocate accounts. That's why it's important as well. So this is something in your 401k as well. It's on autopilot. It's out of sight, out of mind. Don't forget to do the regular routine rebalancing. And if you need any help with that, give Chris McIntire a call, 800-868-1194, 800-868-1194. Now, Chris, number 2 on this list of the 8 moments to move your money. This is one that you've been talking about for years. We call it Rothtober. This is the time of year where we really kick it into gear with doing Roth conversions. Roth conversions, number 2 on the list of the 8 moments to move your money. Can you explain why?
Yeah, it's, because many people know how much income they've already had coming in this year, obviously, and there's only 2 months more in the year, so you can, kind of forecast, where you're going to end up for the year. And if you have some advantages, like, if you're in the 12% tax bracket, and you can pull out another, say $5,000 to $15,000 out of an IRA and move it into a Roth IRA and still be in the 12% tax bracket, that's a move that might be worth considering, depending on what all your financial goals are. So this is the time of year, like you say, call it Rothtober, where we do more Roth conversions, and then, let's say somebody's got an IRA account and, they've got IBM stock and it's down in value. Well, we can shift that IBM stock over into a Roth IRA and then let it recover. So you're paying tax on a smaller amount, and then bring it over to the Roth and let it recover, and increase in price there, which would be a good win-win for you.
Well, again, if we are looking at our balances, Chris, don't beat yourself up that we've built up this tax deferred retirement balance. It probably has been a very good move and advantageous during our working career to do that tax deferred savings. It's just, Chris, for many people, as we are shifting into retirement and we are in a low tax environment, it may be time to sort of change that paradigm and begin to proactively manage those taxes on those retirement accounts, because it's not what we have in there. It's not the balance that's important. It's what we actually get to keep and spend from that balance.
Yes, absolutely. Yep, and want to come out winning the game, not just at halftime.
Absolutely. And by the way, ladies and gentlemen, being efficient with your taxes can be as effective as shooting for higher returns with your investments. But generally with far less risk involved. It's pretty black and white. Don't need to get into the gray area, but some great opportunities for that. And if you would like to quantify what those Roth conversions may cost and ultimately what the benefit, what they may save you in retirement dollars and taxes down the road, Chris can crunch those numbers with you. He can show you side by side. And it's pretty enlightening and eye opening when you see what the tax bill may be versus what you can control it and minimize it to. So certainly worth the time. In many cases, a swing of several hundreds of thousands of dollars or more potentially. So take a look at the Roth conversion and quantify how much it would cost and then what the benefit would be with a qualified, experienced professional. And Chris McIntire certainly fits that bill and can help you understand what that looks like, what it would entail. Give a call, 800-868-1194. That's 800-868-1194. Number 3 on this list, Chris, of the 8 moments to move your money, maybe one of our best opportunities and maybe one of the best kept secrets in the financial world that just not enough of us know about, isn't talked about enough. We know that at age 59 and a half, we can pull money out of retirement accounts without the additional 10% penalty. But 59 and a half is actually a milestone for another very important reason that I think is far less well known.
Yeah, absolutely. And that's the in-service distribution. So let's say, for example, you're working at a company, you've been there for 15 to 30 years, okay, and you've obtained the age of 59 and a half. That's called a triggering event. And in most cases, you are allowed to take and do a direct rollover from your 401k into an IRA, which is a non-taxable event. And then that opens you up to a whole new array or menu of different investment choices that you may have. Maybe you want to look at CDs, for example. You want to look at an annuity to give you an income in your retirement. You want to look at individual stocks, things like that, that probably aren't allowed inside within your 401k.
Yep. And Chris, I mean, if we did have another downturn into the future and we had that balance in the 401k, they are all invested as we have had over our career. Let's say we've got $500,000 and we see a big market decline, a 20% decline. Hey, we've lost $100,000 and 20% of our life's work and savings. Whereas if we take that proactive move, maybe reposition the existing balance, not a taxable event, we get to continue working and contributing and capturing any match that's there. But if we have that same kind of downturn, now it's only affecting the last contribution, which maybe it would be far less money, and we get to take advantage of the downturn with the next contribution, right?
Yeah, absolutely. And, when we do in-service distributions or direct rollovers to IRAs for clients, we still want them to go, and make their contributions into the 401k to make sure they're getting the match at least. And depending on their tax situations, sometimes we just say, look, continue putting as much money as you possibly can in there. When you retire, then we can start doing the Roth conversions. So, a lot of different pieces there. It gives you a lot of flexibility. If you've done a 59 and a half direct rollover to an IRA, boy, it can be a lot easier. Then you can move those specific assets into the Roth. That, like I said, for example, IBM stock was down in value. If it's in your IRA, it's easy to move that into a Roth IRA because, sometimes it's one form that does that. That's hard to do in a 401k. A lot of times, you're going to have to sell that asset to cash and then open up a Roth. Just a lot of administrative work that, a lot of people just aren't going to go through that and put that effort into it.
None of these necessarily difficult exceedingly, but you don't want to make any mistakes on them, right? You want to cross every T and dot every I the correct way so that we're not risking maybe making a costly oversight. And that's where, Chris, of course, the help of an experienced qualified professional is very beneficial to make sure that we are doing these things the correct way and not losing or costing ourselves unnecessarily.
Yeah, absolutely. And, you want to consult with your advisor, with your tax planner, before you do anything that's going to affect your taxable income for a given year. But you have to do Roth conversions by the end of the year, right? This is different than a contribution. you can do contributions until April 15th into IRAs. Okay, you can't do contributions into 401ks after the year to affect the previous year. So you have until December 31st to fund your 401ks. You have until April 15th to fund your IRA. So contributions and conversions certainly can, lead to some confusion, especially if you're hearing this on a radio show versus seeing it in person, where we can lay it out on a computer screen or the dry erase boards like you see behind me if you're looking on the podcast.
Yeah, and not the only difference between contributions and conversions either. I do think that there's a lot of confusion between the two. One has a limit on how much you can contribute new dollars each and every tax year. The other one, you can do as much as you want. One has a limit on how much you can earn before you are eliminated from being able to take advantage of new contributions. The other one, that limitation isn't there. You could be earning as high an income as you can potentially earn and still take advantage of those conversions. So you got to understand the rules in these. And essentially, Chris, there's no one that's absolutely eliminated from being able to take advantage of Roth opportunities. And that's why it's one of the 8 moments to move your money. Next on the list, Chris, and probably the last on the list that we'll have time to get to today, but if you have left a job, don't orphan your accounts. Don't leave them behind. Yes, the 401k is a great opportunity for us to do some savings and investing automatically and sort of out of sight, out of mind, but it should never be so out of sight, out of mind that we forget about our money. Left behind money probably isn't doing the most for us it possibly could.
Yeah, you're absolutely right. I got an old 401k and it's worth $20,000. And it was just as the path of least resistance was, leave it there. I'll worry about it later. That's not always the best thing for your financial future, obviously, because, it's something that you've set it and forgot about it. Maybe you want to, move that into an IRA account of your own, or, one that you already have established, and just going through the motions of doing that. We help people with that all the time because, somebody listening to the show today may say, I got an old Fidelity 401k, but, Charles Schwab is where my IRA is. How do I do all of that? That's where we help all of our clients, obviously.
Well, again, if you need help with any of these moments to move your money, these are opportunities to make sure each and every dollar is working its hardest, doing the job for you that you need it to perform. Then give a call. If you would like the list to go over on your own time, you're also welcome to give a call and request this. There's 4 more. We didn't have time to get to all of them, but each one of these items is important for you to be able to identify if you are encountering it. The 8 moments to move your money report and resource for you, ladies and gentlemen, or if you would like that complimentary review and retirement planning strategy session, or if you just like an Ask Chris Anything session, 5 to 10 minute phone call to ask any question that is on your mind, especially about your money, pick up the phone and give a call. 800-868-1194, 800-868-1194, 800-868-1194, or skip the phone, always available online, McIntireRetirementServices.com. Chris, also, by the way, just an excellent resource on hockey knowledge and trivia. So if you got a question on hockey, that would probably also be within Chris's wheelhouse when you ask him anything. Chris, always a pleasure here. And we are looking forward to another exciting hockey season coming up, right?
Yep, just about ready to kick off, and let's go Red Wings. Well, let's hope they make the playoffs this year, buddy.
Always a pleasure, Chris. And you yourself, pretty impressive skater. I've seen you out on the ice a time or two. Still able to cut it.
Yep, got new skates for my 58th birthday. My wife loves to watch me skate. So one thing I can do, I do have a little bit of athletic talent, not much.
Well, again, Chris, always a pleasure. And ladies and gentlemen, Chris, such a excellent, valuable resource for help and assistance with any kind of financial investment, retirement planning related questions. And these 8 moments to move your money, if you are encountering one, you need to be able to know it, identify it, and then take appropriate action. Chris can help you with that as well. Give him a call, 800-868-1194, 800-868-1194. Chris, take care. Look forward to speaking with you again real soon.
Yep, thanks, buddy. Good to be with everybody. Be safe out there.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.